In this video, we'll discuss the importance of taking control of one's own retirement planning, noting that investors' financial situations vary widely, from wealthy individuals with multiple properties to those living paycheck to paycheck. That's why, even during retirement, some can increase their wealth, others manage to keep it steady by generating enough cash flow, while others have to sell assets to cover expenses. The first step is asking yourself, what lifestyle do I want? What will my monthly expenses look like? And how will I handle things like health costs, long-term care, or unexpected emergencies? A common rule of thumb is saving about 10 times your annual income by the time you retire. So if you earn $80,000 a year, you'd aim for around $800,000. But you can't forget inflation. $1 million is much further than it will in 30 or 40 years, especially in expensive areas. Healthcare alone could eat up more than $170,000 over retirement, and those costs rise as we age. Then there's longevity. Some people may spend 3 decades in retirement. That means it's not enough to just save. You'll likely need investments that keep growing and protect against inflation. Even small compounding effects from dividends can make a big difference over time. Finally, you have to know your risk tolerance. An aggressive stock-heavy portfolio historically returns close to 10% per year, but can lose half its value in a crash. A conservative mix earns less, but feels steadier. The good news, over any 20-year period in U.S. history, stocks have always come out ahead. In the end, taking control of retirement is about balance, saving enough, preparing for inflation and healthcare, and choosing investments that match your goals and your nerves. When building a retirement portfolio, it helps to start with a solid core. Think of this as your foundation: stable, income-generating stocks or ETFs that can carry your portfolio through market ups and downs. Once the core is set, you can add smaller, more higher-risk positions in areas like AI, the energy transition, or other growth opportunities. For a strong core, diversification is key. ETFs are great because they give exposure to dividend income, bonds, and growth-oriented stocks. But if you prefer individual stocks, I'd focus on companies with wide moats, strong balance sheets, and reliable income. Targeting a 5.5% dividend yield is smart. It provides solid income without needing to chase risky high-yield stocks. Here are 4 stocks that could form that core. First one, ONO, ticker symbol OKE. This is a midstream energy company with a massive pipeline network and supporting operations in fast-growing areas like the Permian Basin. Its revenues mostly come from fixed-fee contracts, which means it isn't directly dependent on oil and gas prices. ONIOK has grown earnings steadily for over a decade, even through oil crashes and the pandemic, and aims for mid to high single-digit EPS growth through at least 2026. The stock currently yields 5.8%, and its dividend has not been cut for at least 25 years, growing 3 to 4% annually. Plus, recent price weakness has created a buying opportunity without affecting the company's strong cash flows. Getty Realty, ticker symbol GTY, is a REIT focused on convenience and automotive retail properties, including auto service centers, drive-through restaurants, and car washes. The company boasts an occupancy rate of 99.7%, strong rent collection, and tenants that comfortably cover their rents. Its dividend has grown over 5% annually since 2019, and with a payout ratio under 80%, it's sustainable. On top of that, Getty has an investment-grade credit rating, a net leverage ratio of 5.2x, and an average lease duration of 10 years, giving it both income stability and long-term reliability. VCI owns some of the most iconic Las Vegas Strip properties like MGM Grand, Caesars Palace, Mandalay Bay, and more. It operates on a triple net lease model, meaning tenants cover most costs, and it maintains 100% rent collection. Half of its revenue comes from outside Las Vegas, as the company diversifies into other entertainment areas with strong tenants and pricing power. While Las Vegas has faced visitor declines and layoffs, VC's asset-heavy model shields investors from the operator's risk. The stock yields 5.7% and offers mid-single-digit dividend growth, making it a reliable income play tied to real assets. PepsiCo is one of the world's largest snack and beverage companies, with over $20 billion brands competing with the likes of Coca-Cola. Despite some margin pressure in recent years, the stock trades at a long-term discount, offering upside potential. Elliott Management has identified ways to boost growth, and the company's diversified business model makes it a retirement-friendly stock. It currently yields 4% with potential dividend growth in the 6 to 8% range. PepsiCo combines stability, brand power, and growth potential, exactly what you want in a core retirement holding. These four picks together average about 5.6% yield, combining safety, income, and growth potential. They create a foundation for a retirement portfolio that can withstand inflation, market swings, and long-term risks while still allowing for growth opportunities. Focus on a solid, reliable core first, then layer in growth opportunities. Start with stability and let compounding do the heavy lifting over time. That's all for today. See you in the next one.